Should I buy a property in my personal name or in a limited company? Hey there, future property moguls. Welcome back to the channel. Today, we're diving into a decision that can shape your property investment journey. Should you buy that rental property in your personal name, or is a limited company the better route? I myself have been in this exact situation and unsure what would be best for my personal circumstances. So stick around as we break down the pros and cons of each option, helping you make an informed choice that aligns with your personal financial goals. Please note, when it comes to your personal affairs, always seek professional advice for your specific financial situation, as legislation and tax laws can be complex and constantly changing. Part 1. Buying in your personal name. All right, let's start with the classic approach, which is buying property in your personal name. You simply contact a broker or the mortgage company directly, who then arrange the mortgage for you, and you purchase the property under your legal name. This is straightforward and often preferred by many, and for first-time investors, you can also benefit from paying no stamp duty. By purchasing the property in your personal name, you'll generally have more flexibility in terms of property types, lenders, and financing options. Plus, the transaction process is generally simpler, with lower administrative burdens. The question you will naturally ask yourself is, how is tax calculated on rental income in your personal name? The rate of tax you pay is based on the rental income less your personal allowance and allowable expenses. Your next question may then be, so what are the allowable expenses I can offset against my rental income? You can claim any expenses that you've paid that is directly attributable to renting the property out. Examples include general maintenance and repairs, insurance costs, letting agent fees, legal and accountant fees, and even the interest element of your mortgage payment. The interest element of the mortgage? Really? Yes, you heard it right. However, since 6 April 2020, and as a result of Section 24, the tax relief that landlords of residential properties get for finance costs is restricted to the basic rate of income tax of 20%. This will have the biggest impact on higher rate taxpayers in the main. The tax reduction is calculated as the lower of the finance costs, property business profits, and adjusted total income. As an example, for an individual receiving £20,000 rental income with allowable expenses of £4,500, finance costs of £4,000, and a salary of £60,000, they would pay tax of £11,804. This is summarized as follows. As you can see from this example, the tax reduction is calculated as 20% of the lower of the finance costs of £4,000, rental property profits of £15,500, and adjusted total income of £62,930. The lowest amount is the finance costs, so £4,000 multiplied by 20%, which equals a £800 tax reduction. The individual in this example is a higher rate taxpayer because his total income is more than the higher rate threshold of £50,270. We will get into more detail on why this is important when talking about the limited company option shortly. Overall, the pros of personal name ownership are flexibility in property choices and financing, easier access to mortgages and loans, as there are generally more options in mortgage lenders compared to the limited company route, and it is generally a simpler transaction process. The cons of personal name ownership are that it is generally less tax efficient, especially if you're a higher rate taxpayer, as rental income is taxed at your personal tax rate, and you do not get limited liability protection, which means your personal assets are at risk if you cannot meet the mortgage payments. Part 2. The limited company route. Now, let's venture into the limited company territory. This approach has gained popularity due to its potential tax advantages and increased liability protection over recent years. A limited company is taxed at the corporation tax rate, which is currently set at 25% in the UK. It is 19% for companies making a profit of less than £50,000. The main advantage of a limited company is that whilst for personal ownership you can claim a tax reduction of 20% of your finance costs, for a limited company, interest on mortgages is fully tax deductible, the full 100%. Using the same example as the personal ownership section, the calculation would now look as follows. The salary of £60,000 is still subject to income tax, Overall, it is more tax efficient to hold the property in a limited company versus personal ownership, as the overall tax liability is lower. If you're a higher rate taxpayer, you are immediately paying a lower rate of tax via corporation tax if owned through a limited company. If you plan on growing a property portfolio, then ownership through a limited company may be advisable based on your personal circumstances. Overall, the pros of limited company are that there is potential for tax savings, as corporation tax rates are often lower. There is enhanced liability protection, as your personal assets are generally shielded as the company owns the asset and is a separate legal entity. And the main advantage is you have the ability to fully offset mortgage interest against rental income for tax purposes. On the downside, the cons of limited company are that it is normally more complex setup, and the ongoing administration costs, such as filing company accounts each year, which may require an accountant. There is stricter lending criteria and potentially higher mortgage rates, with fewer companies on the market offering mortgages through a limited company. Part 3. Making the decision. When deciding between personal ownership and a limited company, consider your short-term and long-term goals. Are you looking for tax efficiency, asset protection, or ease of management? Also, think about the type of property you're purchasing. Residential, commercial, and rental properties can have different tax implications. No matter which path you lean towards, always seek advice from financial advisors, accountants, and legal professionals. They can provide personalized guidance based on your unique circumstances and also cover capital gain tax implications for selling any properties in the future, which is not covered in this video. Conclusion. So, personal name or limited company? The decision depends on your financial goals, risk tolerance, and the properties you're eyeing. There's no one-size-fits-all answer, but by understanding the advantages and disadvantages of both options, you're well on your way to making a smart choice. If you found this video helpful, give it a thumbs up, subscribe for more in-depth investment insights, and hit that notification bell so you don't miss our upcoming content. Until next time, happy property investing.